Hello, 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 everybody. Welcome to this VC Lab info session. It's really good to see you all here. Welcome, welcome, welcome. Uh, if for those of you that don't know me, my name is Mike Supervici. I'm the head of acceleration here at Desal Group. I'm also joined by Adeo Resi, who's the CEO of the organization. And it's really good to see you all here. If this is the first time you have joined us for an event like this, welcome. There are two ways to interact with us. Okay. You can introduce yourself and say hello in the chat. There's a chat on the right-hand side of your screen. And if you have questions for me, all right, as we get through sort of this presentation and things like that, there's a Q&A button at the bottom of your screen. And you could add questions in there, you can upvote them, and then we can sort of prioritize your questions and things like this. Before you start posting stuff into the chat, though, I do want to let you know something, okay? There's a concept in venture capital called general solicitation, okay, where you can't talk about your fund publicly or what you're doing. So do not say, hey, my name is Jason and I'm working on an AI fund that's doing XYZ, okay? That's illegal in most jurisdictions. So don't do that, all right? Just say, hi, my name's Jason, here's my LinkedIn or something like that. That's fine. No problem. Go ahead and do that, but just avoid like mentioning the thesis and what you're doing, because this is a public webinar, right? And so we just want to try to keep you all safe, okay? Before I get started with the presentation, Adele, is there a couple words that you'd like to say as well?
Yeah, I wanted to come on here, guys, and thanks everyone for showing up. Great attendance, by the way. I'm really excited for Cohort 18. I know there's a lot of turmoil in the market. Many of you are witnessing kind of craziness all around the world. And actually, that is historically literally the best time to invest. So, some of the greatest companies in history from Instagram, Slack, whatever, came out of the 2008 and 2009 uh, crisis that happened. And what generally happens in these periods of time is that there's some sort of economic pandemonium, right, that we're witnessing right now. Uh, People get scared. A lot of investors don't invest. Valuations come down a bit. A lot of people are like, oh, now is the time for me to make a career change. I'm going to launch the company I always wanted to. There's more talent available. And so this combination of crisis, talent, ingenuity all happen at the same time, and just fantastic companies get created usually around now. So if you look at it, it's been kind of, we've been in sort of edging on crisis. It was like 2024 wasn't the best year. And then 2025 really had a massive correction at the beginning of it, which we're still kind of in. And then as you're coming out of that peak nadir moment, that's when you start to see some of these great companies get created. And so literally we're in that time period right now. It's literally happening right now. And on top of that, there's about $6 trillion of money that's been pulled out of debt markets, pulled out of equity markets, pulled out of various different investment vehicles that is sitting on the sidelines looking to be reallocated. Some of it will be reallocated in 2025. And a lot of it will be reallocated in 2026 as as the people that pulled the money out, do their annual planning again in 2026. So there's a ton of money sitting on the sidelines that is ripe for the right manager to manage on behalf of these limited partners and invest in startups, aka that's you. So there's money on the sidelines, a great time to invest. And so I wanted to come here today and just convey this to everyone here that if you're going to start a firm and a fund, or if you're working on your new fund, this is the best time, guys. Like, there's been good times that we've had. Like, it was pretty great in 2021, right? The similar kind of thing happened, right? Now it went a little haywire in 2021 for other reasons because governments around the world pump money into the economy and then people just pump money into venture capital, right? So it was slightly different, but it was also quite a good time coming out of the pandemic, right? But that was more of a bubble. This looks like it's going to be one of these big reset periods where you see just massive growth afterwards. And if you're going to move, you can do it now. $6 trillion of money sitting on the sidelines, tons of great startups to invest in that are coming. It's really just a fantastic time. So Mike's going to take you through everything that you need to know, but I wanted to come on for a few minutes to convey this because, and Mike, should I show the slide quickly, the infamous slide on like past downturns, just to give an example?
Yeah, I think you should. And while you do that, maybe I can also just add a comment.
Sure.
We're sort of right midway through cohort 17, the cohort that came before you, and it's sort of our at this point it seems like to be on track to be our most successful cohort from a fundraising perspective. So a lot of the stuff you're seeing and hearing is probably not accurate if we're seeing this on the other side of things.
Yeah, so 2000 was the nadir of the collapse. And then 2001 was the 9/11 terrorist attack, right? And then look at the venture returns afterwards. They just went crazy. 2008 financial crisis and people Slack, Instagram, tons of amazing companies all around the world were born in this time period. And look at what happened to the venture returns. And so you want to look at venture returns like more than a decade ago so that because what this is showing is the vintage year of the fund, right? And then the returns. And you want to look at returns from 10 years ago or more because that's the lifetime of an average fund. So looking at venture returns from 2020 or 2021, it's only, 4 or 5 years ago. It's too soon to really know if those were good vintages or not. You can get some early indicators. So, but yeah, you look historically at big crises that humanity has faced, and every single time the returns in venture go way up afterwards based on investments made in that period, right? And we're in that period now. So I'm going to turn it back over to Mike. I really wanted to come and just let you guys know that you have a real shot of raising a great amount of money because, as Mike said, our current cohort right now has raised the most money of any program we've ever run. And it's not like much larger because we put a cap on the number of people we have and firms we have in the program. So it's roughly the same size. So it is quite a good time. All right. So, Mike, you got this. Hopefully, everyone heard me, and I'll be
Thanks,
around if you
Adeo.
need.
Thanks, Adeo. Super appreciate it. All right.
Of course.
So what I'm going to do here, everybody, I'm going to run through a brief, roughly 20-minute or so presentation on what VC Lab is, what VC Lab does, try to preemptively answer most of your questions. Then when we're done with that, I want to open it up to questions for you. And for the folks that joined a little bit late, there's a Q&A button at the bottom of your screen. So I'm not really monitoring the chat for questions. So if you're adding questions into the chat on the right-hand side, I'm not really looking at that, okay? There's a Q&A button at the bottom of your screen where you can actually go and add questions. People can upvote them and we can go ahead and answer your questions as well. So let me just go ahead and get started, talk about VC Lab, and then we can go into your questions, okay? All right, everybody. Cool. So VC Lab. VC Lab is a program that is purpose built to help new managers launch enduring venture capital firms, not funds. Okay. Enduring venture capital firms, not funds. Okay. If you get into this business, you can't get into this business for one fund. If you do, you're gonna go out of business. If you have questions about this, I'm going to go ahead and answer that, why that is. But basically, like, you have to build a firm, not a fund, in order for you to be able to sustain. And that's what we're trying to help people do, right? So we want to help people launch these enduring next generation venture capital firms that are going to become like the future of finance for all of humanity. Okay. What we do is that we offer a free program. It's a 4-month program. And the whole entire purpose of this program is for you to close on your fund. Okay. So we're going to go through all of everything that you need to do. We're going to purpose build the entire curriculum for you to go out and close. And we're, on cohort 18 now. We have launched 600 VC firms, and every single time we do this, we build off of what we learned from previous cohorts, market conditions, and things like this, and customize the experience to help you get to a closing very, very fast. How fast? Well, look, it typically takes a new manager roughly, 18 months to do what's called a first close on their fund. The typical VC Lab alumni right now is closing in a roughly 5.7 months. And that's going even faster with newer cohorts. So why is this happening, right? The reason that it's happening is that most people just do things out of order. Okay, they do things that are kind of a waste of time. I'll give you a good example. Some of you have already started kind of thinking about a fund, working on your fund, have already started talking to lawyers and fund administrators. That is one of the worst things you can possibly do. Literally. So if you're doing that right now, everyone, just hear me out. Like, get off the phone or whatever. If you're talking to lawyers and accountants right now, don't do it until you have 2 to 3 million, right, in hard circled commitments that are signed, right, like with like letters of intent. This is generally not a good use of your time. Okay. It's actually one of the worst uses of your time. So this is an example of stuff that people do that's completely out of order. And as a result of that, that's why generally people take a very long time to close. Another thing that happens is that people just pitch to wrong LPs. Okay. If this is your fund one, literally like the first fund you're doing right now, most LPs are prevented by charter from investing in your fund. So it's not really a good use of your time to spend time with LPs that are not going to invest in you. You got to focus on the LPs that actually will invest in you, right? And so that's the reason why so many funds take so long to close, is because they're like mistargeting LPs and all sorts of stuff like that, right? And so what we're doing in the VC Lab program is basically packaging all of this information so that you can focus on the right things at the right time. And it's purpose built to get you to a closing very, very quickly. Okay. So what does this sort of look like from like a programmatic perspective? Well, look, month one, we're going to make sure that your thesis is awesome. What does that mean? Basically, you're going to build a 1-sentence thesis, and you're going to tell LPs this 1-sentence thesis. And if 1 in 5 agree to invest, that thesis is awesome. You don't need a deck for this. You don't need any of this stuff. So some of you have already started working on your deck. Again, super out of order. If your thesis is not good and it's not converting 1 in 5 LPs, there's no reason in you building a deck, because all a deck is an extension of your thesis, right? So this is the kind of thing I'm talking about here, right? So first month, you're going to go out, build your thesis, start getting commitments from LPs. Okay. Month 2, you're going to start taking those commitments, like building out all of your all your financials, your deck, and all that stuff that you need to go to like the next level of LPs. These are second, third, fourth degree type of folks. Okay. Month 3, you're going to accelerate that process. Okay. And then month 4, you're going to start closing. Okay. And, we're going to give you everything that you need to be able to like do this. But before I go any further, I want to like make this point abundantly clear. This is not a learning program. Okay. This is not a learning program. This is not where you come to learn about venture capital. We have a program for that. It's called Venture Institute, where you can learn all the ins and outs and the basics. Here, you're just going to learn by doing. Okay. You're going to pitch LPs, and close a fund. It's like very sort of like no BS, like type of program where we tell you what to do and you're going to do it and then go out and close on your fund. Okay. Now, In doing so, though, of course, you're going to learn a ton, right? Because you're going to learn, you're going to have to build out all of the materials, everything, right? So you're going to learn a ton. And we're going to support you with all that. But I also want you to know that this is a very practical program. You are expected to do a closing. Okay. You are expected to do a closing at the end of the program. All right. So this is what the purpose of this program is all about. Okay. And this works everywhere. Okay. We have launched 600 venture capital firms. We've done this all over the world. We get these questions. Well, it's like, does the curriculum work in my country, whatever? It's very likely we've launched a VC fund in your country at this point. So yes, it does work. We have an enormous amount of experience operating all over the world with all sorts of you know, issues that you may have to deal with, LPs and stuff like that. So lots, we know this works, right? This was global from the beginning. So I know there's a huge global audience here. So just know that it's purpose built for you as well. Okay. So let's talk about some of the benefits. So first, you're going to get structured curriculum. Why is this important? Because it basically just keeps you on track. And it's like, you know, it takes away so much mental energy. You just like open up the curriculum. I know this is what I need to do this week. I don't have to waste. No, I know that I don't need to waste time on these other things. I can just focus on the thing that's in the curriculum. In addition to that, the curriculum is rebuilt every single cohort based on things we've learned in the previous cohort. It is based on market conditions, things like that. So we're constantly tuning this just like any other like product that's constantly getting updated, right? So you're getting, you know, the most up-to-date sort of information to sort of do this right. Second, every week, you're going to have 2 sessions. You're going to have an Ask Me Anything with myself and Adele. Okay. And in those, you're going to bring all sorts of questions about strategy, whatever is sort of like on your mind. And of course, we're going to do tactical stuff, right? Like we're going to be helping people with whatever issue they have. Oh, LP said this to me. What do I say? That kind of stuff, right? And then you're also going to have a mentor session where we host either very successful general partners that are emerging managers that came before you. We feel that those are generally the better sessions because they're not so far ahead of you to where you can't relate. Like if I were to feature, I don't know, a managing partner at like a very large VC firm, it's not, you know, that hasn't been through what you're going through right now. It's not as useful as an emerging manager that's maybe a year or two ahead of you. Okay. So we have quite a lot of those. We bring LPs, fund of funds, things like that. And we also bring operational folks later in the program when we start working on structure and things like this, compliance, legal, accounting, all the things, ins and outs that you need to do. And also, we do this so that we can prevent you from having making all the mistakes that a swath of people, a generation of emerging managers that came before you did, which is kind of soured a lot of LPs on sort of taking the risk on emerging managers so that you can be institutional grade from day one with regards to how you set up your operations and how you do things. Okay. So all those things are built in, purpose built into the program. Okay. Third, you're joining the largest community of emerging managers, you know, and you're going to have working groups. You're going to collaborate with those folks there. We're in there with you. You're going to join our Slack community, and you're going to be able to collaborate with a lot of folks on this. We have host lots of webinars, lots of events, things like this, so that we can help you, you know, get as much access as possible. Because venture capital, at the end of the day, is a network business. You're going to co-invest with people. You might have might want to share potential investors, things like that. So we want to try to facilitate all that for you. Number 4, you're going to get all the tools to do this. Okay, there's this thing on Twitter. I don't know if you've seen this, the VC stack, which is one of the stupidest things ever, which is basically like where you're cobbling together like 15 different tools with like a Zapier integration. That's bad, right? You're going to manage like $10 million professionally. You do not want to do that by cobbling together a whole bunch of stuff, right? So we basically built it all for you. It's called Desal Hub. You can go to desalgroup.com, select Hub, and you can actually see the product and what it does. It's got over 1,000 venture capital firms using it and handles literally everything. All of your fundraising with pre-built templates and AI, all of your deal flow, baked in deal memos, everything that you sort of need, all of your back office integrated, all of your data rooms, so you don't have to spend a whole bunch of money on DocSend, full on investor onboarding, so you don't have to go out and buy DocuSign and pass through and all those kinds of things. Like everything sort of in one place. So you don't have to sit there and cobble this together, purpose built for all the use cases of VC. Okay. This has become the leading platform for venture capital. You get it for free as being part of the program. Okay. So, and the AI is going to help you find the right kind of LPs. It's going to help you build out the content for your deck. It's going to help you manage objections from LPs because it's been trained on thousands and thousands of questions that we have been answering for the past 17 cohorts, right? And so just the way we sort of run the process is purpose built specifically for you. The other thing is, we have a lot of ongoing support. We help you in so many different ways once you get through the program. We have an entire sort of back office services layer that you can use. We have a vibrant community that you can help. We have an entire capital business, right? Where we have LP marketplace where LPs discover you. We have a fund of funds as part of our business that invests. So there's just a lot of ongoing support because if you sort of think about it, the entire purpose of existence of Decile Group, which is the company that runs the VC Lab Accelerator, is to help emerging managers thrive. I started this talk and this conversation about, hey, we want to try to help you build an enduring venture capital firm, not a fund, right? That means that you got to get to fund 3, right? And so we're building all of our resources, all of our R&D to get you to fund 3. So all of that is purpose built, okay? Like I said, full stack, operations built into Decile Hub, handles everything that you need to sort of manage your entire firm, everything. Okay. So these are all like application only programs. They're available, but I just wanted you to know. The final thing I'm going to talk about here, and then we can move on, our fund of funds, unlike most fund of funds, specializes in investing in new and emerging managers. Most fund of funds don't. We also have an LP marketplace that currently is placing up to 10% of or more of the fund's entire fund size already, and that seems to be working well. We're also training hundreds of LPs every single quarter at this point on how to invest in you all, and so all of this is built into what we do. All right, so yeah, the whole entire purpose of existence of Decile Group is to help you build an enduring venture capital firm, and VC Lab is the first place to start. Okay, so I'm going to stop right here with the presentation. I see that there's some questions coming into the Q&A. If you joined the program late, I'm still getting questions about how much is the program. Seriously, that was like the first thing I talked about. It's called free. All right, but everyone, there's a Q&A button at the bottom of your screen. Okay, do you see that? There's a Q&A button. Put your questions in there, start upvoting them, and I'm going to go ahead and start answering questions now. Okay, so let's go ahead and get started here. Why is it so easy to start a VC firm? What's the catch? It's not, I never said it was easy. It's actually super hard. Okay, it's really, really hard. You're going to have to pitch 200 to 300 LPs to close your firm minimum. So it's not that it's easy. We just make it easier, right? Because we package everything together so that you can focus on the right thing at the right time. And, it's, we prevent these major issues that often really create enormous problems. Some of them even end up killing funds ahead of time by sort of giving you the right advice, but it's not easy. It's hard. Okay. I mean, just think about what you're doing for a second before I go into any other questions. Just think about what you're doing. You're like basically going to a whole bunch of investors and saying, hey, limited partner, please invest your money into my fund so that I can manage it for the next basically 15 years of your life, even though I've never managed money professionally before, or even though I've never had a real track record. And I know there's a lot of angels and SPV syndicate leads. Those aren't really considered real track record, by the way, right? Certainly by sophisticated limited partners. And so it's a hard sell, right? But it's definitely possible. Like I said, we have 600 firms that we've launched, and we're going to help you make that happen. Okay. All right. Other questions. Let's see here. Is that 9% Latam? Yeah, and then it's 9% of the 600 firms that we launched. Okay. Why is it in some way why is it in some ways easier now to be a new emerging managers versus fund two or fund three? Uh I don't know that it's necessarily easier, Elizabeth. I think that it's true that some of the folks that were able to raise a lot of capital, let's say in like 2021, that level when sort of we're peak market, are probably going to struggle more at this point because, you have to basically, like right size your fund moving forward, right? So if you're able to pull down, I don't know, $100 million in 2021, it's going to be harder for you to do that now. And so, you're going to have some, and you're going to need to show DPI. So in other words, you're going to need to show cash on cash returns, like money returned. And a lot of venture funds are taking a lot longer to do that, because companies are staying private longer, that kind of thing, right? And so if you're kind of a new manager with a small fund, which is, you now have the opportunity to kind of do that, get to market faster, do things faster. Because your fund is smaller, you have much higher opportunity to create returns, right? Because it's much easier for you to 3x or 10x a $5 million fund versus a $100 million fund. You have more exit opportunities because there's secondaries available and things like that. So, those are some of the reasons why, it is a good time. And then you're also drafting off some incredible things that are happening in the market, AI and things like that. I'll give you an example. So, our internal fund of funds, Premier One, we're about to sort of do an LP meeting here, and basically, like our fund of funds skip the J curve. So for those of you that don't know what the J curve is, maybe we can put the article in the chat on what a J curve is. But the bottom line is when you invest as a VC fund, you actually go into the negative for like 2 to 3 years, right? Because you're basically making investments, you're taking fees and things like this, and none in your companies haven't been marked up. Okay, so it's very common in the VC world to have a J curve. Our fund of funds that invested in a whole bunch of VC funds that have come out of VC lab, right, basically skip the J curve, right? And so it's just a good time from a being able to pick and being able to invest. And even though there's obviously some challenges with fundraising. What is the success of your previous cohorts ability to successfully raise? Elizabeth, you have to be able to close on capital to finish the program, period. It's what it is, it's so I don't know. I mean, I guess it's like 100% or whatever, if you look at it that way. This is why the program is designed the way it is. Basically, if you remember that slide that I showed where I was showing sort of the portions of the program, you're constantly validating. And if you can't get commitments, right, in the first month of the program, that's a pretty good indicator that you're probably not going to be able to pull this off, right? And so, boom, just drop out, come back to a future program when you're ready. And so that's how you sort of want to think about this. And a lot of the issues with regards to people getting commitments is that there's not really a GP LP thesis fit. And this is why I was trying to tell people like that are working on their deck, it's usually a bad idea to start working on a deck because most LPs are not going to invest based on a deck. They're going to invest in the manager, right? This is the difference between raising money for a fund versus a startup. In a startup, you have a company, right? And you're like talking about what the company's doing, all this. As a manager, you're saying, hey, I want to back Elizabeth. That's basically what it is. It's like, and so there needs to be something that makes you uniquely qualified to overperform, and people in your network are going to invest in that if that is in fact the case. And we just in our applications process, right, we look for people with great networks that are able to kind of pull this off as well, right? So that's part of the admissions criteria. But even if even if you didn't have a good network, you wouldn't be able to be successful in venture anyways, because the entire business of venture is a network business, right? And so those are some of the things that um, are the difference between like success and failure. And of course, like, look, some people go through this process and they're like, hey, I don't know if I want to do this for the next 15 to 20 years of my life, right? And that's okay too. The program creates the ramp off to ensure that because if you're going to commit to this, right, you're committing for 15 years minimum, most likely 20, right? And so it's a pretty big undertaking for a lot of folks. What is your business models? Our business model is that the entire program, everything we do is free. There's no catch. This is not a freemium thing where we're like trying to upgrade people and things like this. And we basically build what the community is asking for, and in some cases we have to charge for that. So I'll give you a couple of examples of ways that we make money. In the accelerator experience, some people ask for sort of like more like specific, like private, like office hours and things like this. We charge for that sometimes. Some people want to need, actually pretty much everybody's going to need back office legal compliance and all that stuff. Yeah, we have an entire offering, and we can put this in the chat, called Decile Partners. It's basically one of the leading back office uh, platforms there is. It has a 94 NPS, over 150 firms are using it. And of course, there's a cost to that, right? Because accountants cost money, right? So that's part of that as well. Some people are going to want to use some more advanced premium features in Decile Hub. You can upgrade to those. This is the software platform, but you're not going to need to necessarily do that. But some people will want to do that. So that's another one. And I would say, like, the other one is that, look, we have a fund of funds, right? We invest in funds. We make money by, hopefully you guys returning. And that's another part of our business model as well. Okay. So the way you probably want to think about this, if you want to take a step back, we are aligning our business model with your success. The company's called Decile Group, right? Top 10%, right? So we're trying to basically help managers get into the top 10%. And so we try to align our entire business model to achieve that versus servicing a fund, for example, right? So hopefully that gives you enough clarity. Go to decilegroup.com and go ahead and learn more about all this stuff. Okay. All right. What would be the appropriate background for candidates that join the program? So there are four types of people that tend to be very successful in the program. One are what we call like network leaders. People that run accelerators, people that have large communities of founders, people that I don't know, are thought leaders in a specific space. And as a result, they're like advising a ton of founders and stuff like that. Basically, people with like really high like networks and are like network leaders. Another archetype of folk that does really well are angels that have done this for a little while and say, hey, I want to scale this up and actually turn this into like a business. And this also means folks that have run like syndicates on the side and things like this, because they got tired of saying, hey, I'm going to try to fill SPVs all the time. It's really hard to do that. And say, I want to run a fund. We have a lot of folks like that. Many, if not most of the top syndicate leads on, say, like an AngelList or one of those kind of platforms have gone through our programs, and most are using our back office for their fund one or fund two. Another archetype that tends to do pretty well are like spin outs. So folks that are like leaving their current firm and starting a new one, that kind of thing. And then there's others as well, other types of archetypes, like kind of like executives at organizations that have like built amazing networks as a result of that. So we've seen some of those folks do really well as well. So in other words, think of it like kind of operators. So those are the four types of folks, and what all of them have in common, if you want to just go a little bit higher level, is just big, great networks, basically. What are your selection criteria as you choose participants for the cohort? This question from Peter, great question. So the way you want to think about this is that I think I was telling a previous person before this, you want GP LP thesis fit. Okay. And so one of the things that sometimes we see is I say, like, we see a person that, I don't know, maybe was a physician their entire life, and then they're like doing like a crypto fund. And it's like, what? Why are you doing a crypto fund, man? like your entire network is in healthcare, right? And like, so we just want to make sure that you have that. So that's first. Second, we look at your network. We look to see how big your network is, right? Because most of your fund one is going to be raised from your network. It's not likely that you're going to get too many random individuals that you don't know, certainly in your like first or second close of your fund. So we want to make sure that you have people in your network, a big network, oh, I should say that you have a big enough network to sort of like pull this off. And then finally we look at sort of like sometimes like the viability of what you're doing. If you're doing like a fund that's investing in something really small or something, maybe that'll stop it. Sometimes we see people that are trying to do things that are like not VC funds, and the reason we don't make an exception decision there is because just the programs might not be is not set up to help hedge funds, for example, even though quite a lot apply. We just don't have the expertise on staff to help you, and so we look for that as well. um and so those are some of the things we look for. Obviously we look at your video and things like that, and it's really important that you also abide by the principles of the Mansari's Oath. So everybody who gets accepted in the program is going to be asked to publicly post the Mansari's Oath, because that's really important. We only want to work with ethical VCs that want to make the world a better place. Okay, what if you have more than one product? It's really hard for you to be in market with multiple products. Okay. Like for you to raise multiple funds at the same time, that's super hard to do. And you're likely going to fail because you have like this sort of like message confusion. It's like which one or which one. When people go into market with multiple product, when you get to like the level of like a light speed, so you become an enduring venture capital firm, you're on fund 4, fund 5, you probably now have 500 million or so under management. You could hire full on investor relations, and then you can be sort of in market with like multiple funds, because at that level you're pitching at with very institutional LPs that are sort of like basically investing in the data and things like this, and they can sort of make asset allocation decisions. For pretty much everyone on this call, that's not going to be the case. You're going to be pitching high net worth individuals, small family offices, and ultra specialized fund of funds like That's All Capital and things like this. And those types of LPs are basically investing in the person and whether or not they believe that this person can pull this off, right? They're not really investing in data because you don't have any data. Okay. Even if you've run, 300 syndicates on AngelList, that's not actually the same kind of data that will prove to an LP that your fund one is going to be successful, because running a fund is very different. It's blind, right? It's, in other words, LPs, are betting on you to make are completely delegating the decisions to you. How are you managing this business? How are you handling conflicts of interest? It's not just performance, it's predictability and performance. There's so many other factors, right? Which is why fund ones, tend to, that's why many LPs are prevented by charter from investing in fund ones, and often just emerging managers in general. Most big institutional LPs start to get interested at like fund 3, fund 4. Why? Because in fund 1 and fund 2, you actually have real track record, right? That they can sort of diligence and make decisions. And who is making those decisions at that next level of LP? It's typically employees, right? There's people that are hired by people, right? And so they're by definition much more conservative because they don't want to lose their job, right? And so, you got to kind of maximize what you have with the right type of LPs at the right time, which is why it's extremely difficult for new and emerging managers to be in market with multiple funds. Okay, so hopefully that's helpful. Everyone, there's 15 questions and we got roughly about 15 minutes. can you please go into the Q&A and just start hitting like the like button or the upvote button so that I can go ahead and prioritize the questions that are most relevant to you all? I would really appreciate that. It'll help me do this. We're looking to raise a defense tech fund. Give me your views on the defense tech industry. Many tech. It really depends on kind of where you're at in the world. I don't know where you're at in the world. There's definitely quite a lot of activity, obviously, in Canada right now, where people are trying to sort of reshore some of the stuff, some of their stuff. So I think that there's opportunity there, and I think there's obviously some opportunity in the United States as well. And I think there's also, just given like some of the conflicts and stuff, something in Europe as well. So I think that is an opportunity for sure, and it just really depends on like why you're like the best person to go after it, right? Like it's a kind of a gnarly way to invest, because you have to like be very good at understanding startups that can sort of work with like government and government contracts and have the ability to do that. So you have a very different sort of diligence risk. And so in some cases, especially if the LPs are not familiar with this, then you're going to have a hard time with them. And with the LPs that you are kind of familiar with this, let's say there's like government programs and things like this that really are trying to push some of these things, Matt, then you have to really prove to them that you're like the best person in the world to sort of like diligence this stuff and do this stuff really well. Okay. But there's definitely, I would say an uptick in interest from various bodies in the world in this type of stuff right now, more so than historically, right? So it's definitely a good time to think about that, if that makes sense. Um, what is your funnel process? How many people apply? How many people get into the program? Have the 600 have all of them successfully raised funds? Yeah, so the 600 alumni have raised funds. But I'll tell you the funnel right now, Michael. Basically, roughly 3,000 to 4,000 people start applications for every single cohort that we do. We typically select 300 or so people to make it into the program out of that, because beyond that, it just gets a little too difficult to sort of manage for, and the experience starts to degrade. And roughly a third of those, maybe a little bit less, maybe sometimes a little bit less even. So basically 50 to 100 end up finishing the program, becoming an alumni, and closing. That's typically the process of the program. And the program, like I said, is kind of purpose built to allow people to sort of like offboard if they feel like this is not working for them. Okay. And so hopefully that gives you enough clarity on how to kind of think about this. All right. Does starting a VC firm expose your personal assets to liability? I mean, I don't know. Like it's hard. It's hard for me to answer that question. I mean, I don't even know where you're at in the world, but I don't know. Let's just assume you're in the United States, Jacob. Okay. In the United States, people can sue you for whatever they want, right? And so like there's no like structure, nothing you can like really do to protect yourself from being sort of sued, right? I mean, it's just, the best thing you can actually do has nothing to do with structure and legal agreements, right? It's how you manage your fund. If you manage your fund based on the principles of the Mensarius Oath, and you take this super serious, you use a full high-end back office provider like a Decile Partners or something, where like that's super proactive, that's going to like tell you don't do that, because if you do that, that's going to be a huge issue for you, then you're fine, right? This is like, ethics is a huge part of this, right? So if you run this thing on an ethical basis, you're not going to have any issues. The people that have issues are the people that do unethical things and bad things, like putting LPs on different capital call schedules and weird stuff like this, and like not managing conflicts of interest correctly, and that kind of stuff. And so, I mean, generally, so yeah, so it's not really, it's really hard, right? For like, remember, you're setting up companies, right? Like these are companies. This is like a fund with a whole bunch of companies. So there's a lot of like like limited liability, right? Because of just that alone, right? And so, just do things the right way, man. If you do things the right way, you're not going to have any issues. If you do things poorly and unethically, you're going to have a lot of issues. And at that point, it's fair game, and maybe and that's probably how it should be too, right? All right. When pitching LPs, what are different strategies we learn to make LPs accept our thesis and invest with us for X number of years? Well, I mean, the couple things. First, you just have to get the thesis right. Like I'm telling you, if once you get the thesis right, and maybe we can put in the chat the pre-curriculum on the thesis. Like the best fundraisers that we see, like 1 in 5 people literally sign a letter of intent that they're going to invest just by talking to them about this 1 sentence thesis. So first things first, get the one thesis right, because the 1 sentence thesis covers everything. It covers kind of how you're going to invest, where, what, and why you're the best person in the world to do it. The second thing we do is that we help you manage objections correctly. What to say, when, how to ask, that kind of stuff. All of that is built in. Desol Hub writes your emails, gives you templates on how to sort of follow up. DAI tunes them to your voice and how you like to write. But it's also uses a lot of the strategies that we know to help with sort of conversion. Those are all built into the strategy and things like this. And we just host a lot of group sessions, right, where we sort of go through it with everybody, say, hey, what's going on, what's happening with you, that kind of thing, right? And so those are some of the things we can do. But it's hard for me to just give you like super concrete stuff based on like the question that you've answered, but hopefully that gives you enough color about how we sort of deal with this in the program. Okay. Do most folks once accepted have full-time jobs? Are you expected to be program fundraise? Are you expected to like quit your job? I don't know, about it's maybe 50-50, Elizabeth, maybe a little bit less or more. I'm not, it changes every cohort. Here's how you want to think about this. You're starting a company, okay? You're no different than the founders that you're backing. Okay. It's just that instead of you doing a startup, you're doing a VC firm. And so, a lot of companies can get started and do get started part-time. It's sort of like kind of par for the course in many cases. Okay. But there is going to be a limit, of your time when that's just not tenable anymore. And so for a lot of people, that is typically month 3 in the program where they're like in closing mode. And that's like, closing, it's like 60-70 hours a week. You're like talking to LPs, that kind of stuff, like asking them what's going on, objection handling. Other people can get to the first close, maybe even the second close of their fund, before they can sort of go all in full force on this. And there's some that are able to sort of manage doing the fund and doing some sort of part-time consulting work that complements the fund. This is also very important, even for like the entire fund 1 until they get to fund 2. Okay. So, but in general, it's more about how you think about this. I mean, just think about it from like your investor's perspective. They're giving you money to manage their money for the next 15 years, right? You kind of want a full-time manager that's sort of all in, right? That's going to do this well for a long period of time, because, once there's like actual distributions, it's an enormous amount of work for you to get the money and make sure that they get the money and all that. It's not like it just happens, right? It's a lot of work. This is why they're paying you, 2 and 20. Okay. So they're paying you 2% a year. So in other words, 20% of their committed capital is going to paying you, right? So if I'm investing 100 grand into your fund, Elizabeth, 20,000 of that is going to be for you to manage this money for like the next 10 years. Right. And so you do want your manager to make this their number 1 priority. Right. And so over time, you are definitely going to, need to kind of think about going full time. Are you supposed to be an accredited investor to start a fund? No, you don't need to be an accredited investor, but all of your LPs will need to be. I have zero experience in VC, but would like to pivot from commercial credit. Would you recommend this program or venture institute first? Can you do both at the same time? You definitely can't do both at the same time because they're very intense programs. Look, many people, I would argue most people don't have experience in venture. Even the most high-end angels that have done 300 plus investments, and many of them are in our programs, that doesn't mean you have experience running a venture capital firm. Okay. So I don't know, most people that are new and emerging managers don't have that much experience. It's just, again, like, this is why there's a term for it. Um, that being said, Mary, like, look, this is not a learning program. You're going to close a fund, and you need to be uniquely qualified to succeed by finding really good startups. And so if you feel like you have a thesis that works, and this is something that you want to do, then by all means go into the program. We've had a lot of people with various levels of experience go into the program and succeed. If you're not there yet and you don't know that this is sort of what you want to do, that kind of thing, then yeah, go into Venture Institute and like learn about what it is and how venture capital works and stuff like that. Okay. All right. Uh, do you provide salary support, blah, 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 for the program? No, there's none of that. This is a free program, team. Okay. Can a new GP raise a fund without putting in their own funds investment? It's possible, but it's kind of hard because basically LPs expect for you to invest 1% of the fund. They kind of want to see some skin in the game. It's a bit less so when you're raising smaller funds, let's say under 5 million and things like this, but anything in the 5 to 10 million range, it's kind of like par for the course. Okay. Now, look, there's ways to manage that. For example, you can move in an angel investment that you did into the fund. That's called warehousing and it counts towards your GP commit. But no, you need to have at least 1% of the fund. Okay. All right. Our group has 2 GPs and a third fundraising partner with the same equity. Is it only open to GPs or should the founding partnerships participate? You want basically all of the managing partners to be there into the program if you can. Because otherwise what's going to happen is that the people that are in the program are going to be like here, midway through, and the person that's not is going to be here, and that's critical. I do have some concerns about your team though, at least the way you're describing it. Like, all the managing partners need to fundraise. There's no such thing as a person on your team that's any kind of partner that's not fundraising. That's critical. LPs are going to expect that. So you can't like delegate fundraising to a person that has like a network or something. That's kind of a mistake. So everybody's going to have to fundraise. Just want to put that out there, irrespective if you join the program or not. Okay. I'm going to do 2 more questions. Everyone, just so you know, cohort 18 application deadline is May 12th. There's I think a link in the chat for where to sort of apply. Go ahead and apply there. You can also learn more at desalgroup.com about the program and everything like this. Okay. All right. Let's see here. You mentioned that it takes a VC lab 6 months to close on average. Is it typically 6 months from starting a program or once finishing the program? No, you're expected to close on capital in the program. Okay, you're actually going to be getting hard commitments from limited partners within 2 to 3 weeks of starting the program. Okay, this is a fundraising program. It's a closing program, so that's all part of this. I think I can handle your question, Chris, about like co-invest, about like kind of putting money in and stuff like that. Do you see value in the program for a fund that has executed first close? Yeah, we have a lot of funds that come in executing a first close, and many often tell us that they wish they would have started earlier, but they had, for sure, there's a ton of people that have done a first close. And as a matter of fact, a lot of people made a lot of mistakes on the first close, calling too much capital, doing capital calls higher than 25%, all sorts of like kind of bad things like that. And so we try to help you fix that, some of that stuff. Okay. All right, here. Will you go into details of vetting companies, risk return profile? Yep, we're going to go through all of that. We're going through all of that, but it's primarily focused on uh, raising capital. Would you're probably beneficial for an economic development org that is launching an SSBCI fund utilizing third-party administrator? Uh, yeah, it's fine. You don't have to use any in our administration. Those are like optional things that you typically have to apply for. So, you know, it's fine. It's just that SSBCI is really difficult to work with in general, and they create a lot of restrictions and are not the most optimal LPs typically, right? And so, just kind of something to think about there. Okay. Let's see here. Does the target amount enter into the program matter? Yeah, it does. We see a lot of people that try to raise way too much money and fail because you can't get undersubscribed in your fund, everyone. And so, like, yeah, when we see people that are like are putting in, I'm going to raise a stupid amount of money, even though I've never raised them a fund before. Like, yeah, that generally looks bad, and we're probably not going to accept you. Like, if you're trying to put in your application, you're trying to raise $300 million, and you've never raised a fund before, and you're not it's like you haven't had 2 or 3 funds before this. Like, yeah, it's the other way. The problem is that most people overestimate their ability to fundraise, and you can never, ever, ever, ever end up undersubscribed. Otherwise, you can't raise more money in next funds. LPs get upset, they start pulling money out. There's all these problems that happen. So what we actually do in the program is we pretty much drive most people's fund sizes down. Okay, because again, it's just so dangerous to be undersubscribed, and we see so many people that think they can raise 10 million. It's just like really hard. Even 20 to 30 million for a new manager is super hard. And I've seen this in like emerging markets. Like I've seen people in like, emerging markets trying to raise that kind of money. And it's like, dude, there's just not enough LPs to even pull that off for a fund one, right? And so, yeah, it does matter more from that. And, but it's okay, right? If you come in and you sort of take the advice and all that and resize things over time. So that's okay, but it does matter. Um, uh, all right. Uh, you know, so I think we're good here. We're right at the end of time here. So I'm gonna go ahead and stop with the questions here. Everyone, this works. It's 18 cohorts in. We've learned a lot about what works and what doesn't. Happy to share that with you. Happy to work with you in the program. And if you're looking to build like a next generation ethical VC that's trying to make like a world a better place, just apply. Just apply. We do this program every quarter. So if you're not ready now, maybe come in whenever you are ready. And again, the program is purpose built, right? It has the constraints, it has the off ramp if it's not the right time and things like this. So we're all here to help. And, I think if you just think about it, what venture is and what venture does, it's one of the most optimistic and positive asset classes, right? Most of the future of humanity is going to be built by venture backed startups, and there's no reason why those can't happen all over the world versus just in one place like Silicon Valley. There's no reason that there's that more and more companies shouldn't be available for people to sort of work with and use and things like this. And VC is the change that makes that happen. So apply, come into cohort 18. And if you have any more questions, we're going to be doing webinars like this on a regular basis, pretty much every week. All right. Enjoy the rest of your day, everyone. Thank you.